And now, without any further delay, let's begin today's event, Identifying the Blind Spots, Loss Trends for Seeing the Big Picture, sponsored by LexisNexis Risk Solutions and hosted by Digital Insurance. And with that, I would like to turn the floor over to your moderator, that is Pat Spear. Pat Spear, pardon me. Pat, you have the floor.
Thanks, Phil. Thanks very much. Thanks to all of you for joining us today. We have a lot to talk about, so we're going to jump right into our topic, looking at the big picture when it comes to commercial lines risk assessment. We have two industry experts who are going to be providing us with some important information. So I'm going to tell you what Phil already told you, and that is if you have a question at any point during the presentations, don't hesitate to type it in. We're going to try and get to as many of your questions as we can. And if we are not able to get to your question, we're going to be having a member of the team getting back in touch with you, so no question will go unanswered. Okay, today we're going to be hearing from Ben Lim. Ben is Director of Commercial Insurance for LexisNexis Risk Solutions. In this role, he's responsible for leading product development and market strategy within the commercial lines insurance business. Ben has more than 12 years of insurance product development and management experience. Prior to joining LexisNexis, he served as Director, Commercial Automobile Line for the Hartford, and has several product development roles with the Travelers Insurance in his past as well. Ben holds an undergraduate degree in business with a focus in economics and finance from the University of Hartford. We're also going to be hearing from Sarah Heslin, Senior Director of Product Management Insurance with LexisNexis Risk Solutions. Her professional background includes more than 18 years of insurance leadership roles in sales, process, billing, and customer service centers within some of the nation's leading insurance carriers. Sarah actively leverages this extensive experience to improve development and management of pre-fill, property, compliance, and renewal solutions for LexisNexis Risk Solution customers. She has an undergraduate degree from the University of Wisconsin in Madison. So without further ado, let's get started. Sarah, I'm going to hand the floor over to you.
Thank you so much, Pat. I just want to thank everyone in advance for being with us today. You're probably looking at this thinking, why is there a kid in my commercial lines presentation? And I wanted to open with a short story, just kind of about a personal blind spot that I think correlates to the information we're going to share with you today. I always ask the question, how many of you have kids, a niece, a nephew, or you remember the awkward years of middle school? Right now, this is not an actual picture of my daughter, but I have a 13-year-old daughter and an 11-year-old son. They're both in middle school, and when I ask about how is your day or what's going on, you know, it's about a two-word answer. It's all good. Everything's fine. It's okay. I have too much homework. But as a parent, I'm most concerned about their grades and how they're doing academically. We have high standards. And so luckily for me, in my school district, we have access to their grades. And so imagine my surprise when we do our weekly check-in and I discover these two grades that you can see on the slide. They are far behind the 90 that we strive for. And so the data was available. I was able to see it. We were able to have a conversation with our children, get them into a study session, and get them back on track. So this is what I call my parental blind spot. And so today we're going to move forward in talking about how you can uncover the blind spots within the commercial auto industry. Knowing about prior losses can help in. If you don't know about the prior losses, then you certainly can't price appropriately for them. So to say it a different way, if you have an accurate understanding of the prior losses on a risk, you'll be better able to price those risks and improve your overall profitability. So today we're going to share on my screen here a few facts as to why we think commercial auto loss ratios have been increasing, the value of the data that exists today to provide loss history information, and how verifying prior losses means improved profitability. So first, I'm going to start out by sharing some industry trends, and then Ben is going to walk through some actual real-life current loss history data findings, the blind spots. And from there, we're going to talk about how you can move forward in using this information. So we all know it's an uphill battle and the environment is changing. So in our dealings with the industry, the voice of customer, from both the executives to the front lines, they are consistently saying that higher frequency and severity are responsible for the elevated losses in combined ratios. Okay, that's fair. So what are the trends? I'm fairly certain that the graph that you're seeing on your screen right now over to the left is not a surprise. It's the Insurance Information Institute graph featuring the rising combined loss ratios. That's clearly an upward trend on the red, right? So additionally, we did some additional reading and research, and the 2017 Conning Report on Commercial Auto Insurance Strategic Study Series, Commercial Automobile Insurance, Fix Me Please, and I know that was a lot, but I want to properly credit Conning for the work and the efforts that they put into this. But here's what was most compelling, is that from the years 2003 to 2010, we are far under 100% combined ratio, averaging about 94.9. And then in the more recent years, from 2011 to 2016, that was well over 100%, with an average combined ratio of 106.7%. Pretty compelling that we've had a major shift. And so what are the things that are driving some of those? So there are specifically two trends that we think are impacting most seriously and most specifically to the commercial market. And that is younger drivers. With the economy challenges back in 2008 to 2010, there were a lot of people just getting out of school and they couldn't find jobs, and so, hey, I could go be a commercial auto driver. And we all know that younger drivers are going to put pressure on both your frequency as well as your severity because they just lack experience in driving. And so that's one thing. Second, I like to make this joke, and although I can't hear you laugh, I'm hoping that you will. But if you've ever been home from work in the middle of the day, what happens is you see all those ads aggressively targeting you. Have you been in an auto accident? Have you been hit by a big truck? Call us now and we'll save you money. We'll make you money. So, I mean, there's tons of lawyers standing around soliciting your phone call, trying to make those bigger payouts on those truck-related incidents. There's also a higher frequency of attorneys that are pursuing large trust payouts because they know that those commercial losses can offer a bigger settlement at the end. And again, it's some of that turbulence in 2008 and 2010. Lawyers were looking for new avenues on ways to make money just with the market changing. So second, two additional trends that impact both the personal and the commercial environment. And unfortunately, they're primarily in the personal space, but they are just unavoidable to all of us, is really the key message. And that's really lower unemployment. And when I read this, I thought to myself, lower unemployment, what does that have to do with it, right? Well, think about it. I'm now, instead of sitting home every day, I'm going to and from a job. That is going to put more people out on the road. Additionally, if there are more people working, then obviously they have money to spend, which means they're going to the store, they're going to ball games, they're checking out a movie or maybe a restaurant. So the lower unemployment just creates a frequency exposure because there are just all kinds of more people out and about than there were in previous years.
I think we all know the challenges of distracted driving, so that's good. And so I segued into a survey. You know, these are some of the trends that we're reading about in the industry, both from Conning and the Insurance Institution. And so what we really wanted to do is LexisNexis wanted to understand what can the industry tell us, right? This is great that I read it in the report, and that makes sense, but what am I really hearing from the industry? So last year we ran a comprehensive study to understand what's going on. We surveyed over 220 plus commercial lines underwriting, directors, managers, product managers, you know, all different levels of folks to get their feedback on the current state of commercial underwriting. And so we found some big opportunities. 79% of the survey says that when receiving an application, more information is needed. 74% of the survey respondents said that they frequently receive incomplete applications. And 54% of the survey respondents said that when underwriting has to rework and review the quote, they frequently discover inaccurate information. So, all that being said, LexisNexis asked ourselves, so how can we help? And we asked the question of those same people who told us that 70% of the time they're getting incomplete information, and 62% of the respondents felt that automating loss runs would be of value to the commercial underwriting process. Okay, so now everybody's told us that they don't have complete information. They've told us that automating loss runs would help, and despite the value that people see in loss runs according to our studies, we still aren't seeing people take advantage of the information that's available. There are only 1 of 4 participating in automated loss runs. And so all of this, we see all of these things going on, and the fact that it wasn't quickly adopted and yet people see the value, it caused us to pause to say, well, what's going on here? So we went directly to the market, and we engaged with 7 carriers, and we ran some pretty significant tests. And what we're going to talk to you, what Ben's going to walk through, is that information. So we get it. You're skeptical, which is why we went to the market and engaged with our carriers to provide the automated loss run information that's available today. And now Ben's going to walk through those particular findings.
All right. Thank you, Sarah. So, today we're here for insights to be found in the current database. There's no reason to be skeptical, and the current offering allows you to identify some of these blind spots. So that is why the industry has been asking us to conduct these loss run tests on their book of business to better quantify the current value. So as of today, we are at a point where we have run significant numbers of tests, and that can provide powerful insight into the current blind spots that we're seeing across the industry. So I'm going to go through 4 different blind spots with you, and let's just jump into the first one. So blind spot number 1, you as a carrier are moving bad risks across your book of business. So let's call these boomerang policies. Many carriers have multiple underwriting companies. What we have noticed is that the bad risk tends to bounce around the different underwriting companies within your organization. So if you take a look at your screen, here's the scenario. One of your customers had a loss and did not renew. This customer goes out into the market for a couple of years and eventually comes back to you as a new business quote. Now, even though they had a loss with you specifically, we have been told that there is no effective or efficient way to see that at point of quote. For one of the carriers that we worked with, 64% of their total prior losses were from customers that left and came back. Now, this was a total of $57 million. Now, because we had the ability to see all these losses going back 3 to 5 years by carrier, we were able to help them identify this issue. Now, since they have the visibility, some carriers are thinking of what internal processes that they want to implement for vetting these types of boomerang policies. The second blind spot I want to talk to you about is that to a carrier's best knowledge, you believe that your book of business is clean. As you all know today, in today's world, prior losses are acquired either through your distribution channel. So that's either through your agents or your customers. Now, the majority of carriers that we've talked to had told us that, yeah, this is probably not the best way to verify if a quote has prior losses or not, but most believe that it's a small amount and that would have any prior losses anyways. So, to validate that, there was one carrier that had provided us with a test file containing 5,808 policies. To this carrier's knowledge, the policies were all clean, no prior losses. But what they were seeing internally were loss trends in their book that were more indicative of dirty business than clean. So what we did, we took these policies, we ran it for prior losses. What we saw is that approximately 15%, or exactly 14.8% of the book was dirty. So this was higher than expected, and this solution specifically helped find these dirty risks. That was the number one takeaway from this test. So now, based on our survey that we conducted, which Sarah shared earlier, a big issue in the industry is incomplete applications, right? Furthermore, 62% of the respondents felt that automating loss runs would be a value to the commercial underwriting process. This test helps us support that premise. Blind spot number 3. A small number of claims makes up a large amount of payouts. So with this test, we took all the policies for the 7 carriers to identify the loss runs. This was a total of 44,000 prior incurred losses that were identified. And that totaled $407 million in prior losses. So what we wanted to see here specifically is a distribution of claims and if there were any consistent trends across the board. We first looked at claims on a claim count perspective. So on your screen, that would be the blue circles, all right? And so what we saw there was the majority of claims, 85% of it, was less than $10,000. That kind of makes sense, right? The next bucket of distribution that we saw was 14% of the claims came from a bucket of $10,000 to $99,000. And the third and smallest bucket, which was 1% of the claims, were greater than $100,000. Next, we look at loss payouts. So on your screen, that would be the red circle. If you take a look, 20% of the payouts came from less than $10,000 bucket. 36% of the payouts came between $10,000 and $99,000. And finally, 44% of the payouts came from the bucket that was greater than $100,000. Now, we wanted to check and see if this was an anomaly. It was not. This was consistent across the 7 carriers. Over and over again, we see that a small number of prior claims represent a high percentage of incurred losses. Now, let's put this in a different way. Less than 1% of the claims accounted for almost half the payouts here. Oh, let me go back. All right, so now the feedback that we're getting from the underwriting VPs and underwriting directors of different carriers is this. Now that I can consistently and accurately find these claims, I'm going to set up a process in my underwriting workstream, flag these policies for either further review, up price, schedule rate, or just decline. Carriers that we have talked to have told us that this is a day one, low-hanging fruit type execution. If nothing else, at least I will consistently understand the severity of the policies that are coming through the door and that I am acquiring. All right, the fourth blind spot, only searching on the business and not the drivers. So traditionally, we have ran loss runs in the industry on the business itself and reported back claims found on the business. Well, there's nothing wrong with that. Matter of fact, if you do that, you would eliminate the 3 prior blind spots I was talking about earlier. But last year, we introduced a new feature in our loss run product, which was the ability now to search commercial losses on a driver of the business. So now you have the ability to search not only on the business, but also the actual drivers of the fleet. Now, during the year, we have conducted multiple tests with carriers, and I would like to share some of the results and the lift that we are seeing. So, in our study, out of $123 million in total incurred losses from just searching on the business itself, here's what we found. We found an additional $25 million in new incurred losses by searching on the drivers of those businesses. Now, this is above and beyond the $123 million. In total, that was $148 million, or a 17% lift in new claims found. Over and over again, we have consistently seen a 16 to 20% increase in claims found when searching on the driver in addition to the business. So when it comes down to it, this is how searching on the driver really helps. 1, it gives carriers the insight on businesses that are clean who has drivers with prior losses. I'm going to say that again. It gives carriers the insight on business that are clean that have drivers with prior commercial losses. Now, this additional insight could potentially help you change your underwriting strategy, your underwriting guidance, to really outpace the market, right? And third and finally, from a segmentation perspective, this could also inform or modify your profile segment and your segment appetite. So we have a unique and comprehensive asset to assist our carriers in evaluating risks. A lot of carriers are moving in this direction to use these types of assets, and hopefully the 4 blind spots that we showed you today gives you some insight on how you can leverage these types of assets. So Sarah, out of the 7 carriers that we talked to, what is going on with them at the current moment?
So, of the 7 carriers that we partnered with, all 7 are now believers, and 6 of the skeptics are currently in the process of implementing automated loss runs. So, let me say that a different way. All 7 found value in understanding how loss run data impacts their book of business.
Right. And
6 of them were in a position to go ahead and begin the process of implementing and start using this information in their workflows. So let me recap real quick for us. Using the automated loss run data can help you prevent the moving of bad risks across your business. We all know that insurance companies have various underwriting companies, and did I know over here about the loss that's coming to this new location? Here's one way that we can help carriers do this. Remove that blind spot with automated loss runs. Secondly, through our distribution channel, we often are given information, or we tell ourselves, right, that risk is clean. And often, as much as 15%, we find that it is not. Automated loss runs can help us overcome and actually validate the real truth on this business. Thirdly, and this goes back to the slide with all the pretty bubbles, but if you leave with one message about all those different bubbles, is that a small number of actual payouts, the largest payouts are happening on a small book of your business. And wouldn't you want to know about the guy who's had a $250,000 loss at the point you write him? Because at that point, you're going to price it differently, or maybe you're not going to write it at all. But if you don't know about it, you could be setting yourself up for more of the same. Fourth is searching the business only. And I think this is a great one, because even when you run the automated loss runs and you find out that, hey, overall this business looks clean, then could have been out having some major accidents and costing us lots of money. So it's expanding your search to include the drivers on your policies. And automated loss run data can help you remove all 4 of these blind spots. And so using the automated loss run data, how is it going to help you, right? It's going to potentially improve your profitability. So if you know about it, you're better able to segment, to price, to have a follow-up policy. Additionally, it's going to enable faster processing. Instead of chasing back after paper information or making call-outs, it gives you an opportunity to know at the point of quote and hopefully eliminate all the rework and incomplete applications that we talked about. And then over time, it's going to help you revise your risk profile. So as you have better intelligence about the customers at the point of sale, you can see how that information plays out on your book of business to potentially reprice your overall strategy around commercial auto pricing. So next steps. If you're a skeptic, we want to make you a believer, and we invite you to partner with us to run a test. You do need to contribute your claims information. It's a contribute to play environment. And additionally, we have industry experts. We work across the industry as well as have people from the industry. So we have a pretty broad perspective on things that are best practices on how to incorporate this information into your workflow. There are ways to start small and add complexity over time. And lastly, we're here to partner with you to help you diminish and remove your blind spots. And with that, we'd like to open it up for questions.
Thanks, Sarah. Wow, lots of information. We've got quite a few questions in the queue, by the way, so being that it is time for our Q&A, this is a reminder to our attendees that they can still enter questions if they want, and we're going to try and get to as many of your questions as we can. If we can't get to it due to time constraints, just know that a member of the team, the webinar team, will be getting back to you. So, all right, let's get to our first question. Okay, is everything you are referencing coming from just one product? Who would like to tackle that?
Can you say that one again? Sorry, the connection's a little iffy.
Is everything you are referencing coming from one product?
Okay, I'll take it.
Okay.
All right, so yes. Yes, it's all coming from a single product. It's Clue Commercial, which provides prior losses going back 3 to 5 years. You know, it really helps you kind of reduce your risk in the underwriting process with results that are up to date. It's presented in a standardized format, and it's so that it's easy for like the carriers to ingest.
Okay,
Does that make
good,
sense?
good. Yeah, and it's good to know. And it's obviously a legitimate question because you've talked about many aspects of this now coming down to the Q&A portion. So, okay, another question. How does the solution work? So I guess that person is making the assumption that it is coming from the one product and would like to know how it works.
Okay, so really the solution takes the information provided on a customer inquiry and it searches for all the contributed claims that matches that information, so to speak, right? So claims are included in the results based on your eligible line of business of the customer, based on their contributed lines of business. It's also, you know, the policy effective date is included in the inquiry. The goal here is to, you know, to provide you with prior losses before the policy was with you, so that's important. And finally, you know, the customer's reporting period. So how far back do you want to go to evaluate the risk? How far back in a prior loss perspective, that is.
Okay. Yeah. Okay, that's good to know. Here's another question. And Sarah, feel free to jump in if you have a comment to make or you'd like to add some color to whatever Ben's saying.
Sure.
Okay. I have another question that's come in here, and it's called, let me see if I get this right. What type of data is included to get the results you talked about?
Oh, well, I'll take that one. So what we're talking about here are the benefits of having a single database that contains loss history information on multiple lines of business. And so this includes commercial auto, business insurance, small business, as well as workers' compensation. You will receive the prior loss amount, the loss date, loss coverage type, and if applicable, a reserved amount should the claim still be open. You also receive the prior carrier and a description of the loss. And so all of those data elements help at the point of sale somebody make a better decision about the exposure.
Right.
Okay. I don't know if it's okay. I'd like to throw in a bit of my own question here. Is it possible to configure it to be tracking other types of data, or is this the type of data that's already embedded in the system?
So it's only claims information. So it's prior losses. So yeah, it's one stream.
Okay. Good to know. Okay, another question. Aren't commercial loss runs free today?
You want to take that?
I don't think well, as my parents always told me, there's not a whole lot that's free in life, right? Loss runs are a large internal expense for carriers. So, right now carriers have to provide loss run information to their agents. Carriers have to manage loss runs coming in from their agents on new business. Underwriting departments in many cases would handle new business submissions multiple times, gathering and organizing. So, I was talking earlier about one of the ways that this information can help you is instead of chasing after all this information, which is the expense of phone calls, days, you could lose a risk while you're chasing after it instead of getting it right at the point of underwriting.
Okay.
Does that answer your question?
Yeah, that answers the question. That goes back to your parents' comment, though, right? What's really free or whatever. What was that saying? I forget what that was. But
nothing is free in life, right?
Yeah, or no such thing as a free lunch or something like that.
Yeah,
but that's what it was. Well, I understand what you're saying, though. Absolutely. Okay. We're coming up on our time here, too, so I want to make sure we get these next few questions in. How many years of history get returned? Who'd like to tackle that one?
Yeah, so the recommended best practices is really 5 years. Now, I know some carriers use 3 years to evaluate their floor rating, and some use 5 years for tiering, for example. But, with 5 years of loss history, it allows you to have the most comprehensive look back of prior claims. So that's the recommended best practice.
Okay, 5 years. Okay. I think I want to get to this here's one last question for sure we want to get to. There's so many questions in the queue, but anyway, let me read this one. I'm assuming we can search loss history. Let me start over. I'm assuming we can search loss history by entering the business name, but what if the business operates under a different DBA?
I think
who would like to grab that?
I'll take this one. I think I understand what they're asking, right? So, you might have Sarah's Lawn and Garden Company, but, I decided to add my husband to the business, and now it's Sarah and Pete's Lawn and Garden Company. So we could be under a couple different names or change our name over time. And so the good news is with dissolution that up to 5 businesses or business owner names can be included on a single search. And so all the names from the application should be included to get the best results. The same thing can happen with addresses, so it's best to include those as well. It's kind of like the more information you give us, the more likely we are to find the information.
Exactly.
I see. Okay, good. Well, listen, I know we've had a great discussion, and we're coming up at the end of our 45-minute window here. And I know there are still some questions in the queue, but I'm afraid we are going to have to wrap things up. As a housekeeping item, though, for those of you who did not have your questions answered, there's quite a few of you, please know that someone from the LexisNexis team will be getting back to you to follow up and address all of your questions. So not any question will go unanswered. I want to thank our presenters, Ben Lim and Sarah Heflin, especially with audio difficulties, and I think really some great information was shared today, and thanks to all of you for staying on the line and working through that with us, because I think this was a really helpful webinar. And on behalf of Digital Insurance and our sponsor, LexisNexis Risk Solutions, I do want to thank all of you for joining us for this presentation. Have a great rest of your day.